Welcome everyone to today's Emerging Markets Strategy Update webinar, which is going to focus on China. I'm Eric Anderson, and I'm the head of Emerging Market Investments at Milltrust International, which is a London and Singapore-based asset manager with a core focus on delivering global emerging market solutions to investors. For today, after a very brief introduction from me, we're going to hear from the China investment manager, Xingtai Capital, an independently owned asset manager that has been investing successfully in China as a firm since 2014 and provide a very differentiated and unique portfolio. If you look at today's portfolio, only about 3.5% of the current exposure overlaps with the MSCI China index. Xingtai are fundamental, bottom-up stock pickers at their core. They are value-driven investors in Chinese growth, which has resulted in a portfolio averaging around 30% EPS growth and 13 times PE. They have a track record of being early to spot winners at attractive valuations, while also having the discipline to avoid crowded and often poorly performing momentum trades. As an example, they're one of the few China long-only funds with a positive performance in 2018. Today, we're going to hear from Michelle Lung, the CEO and founder of Xingtai Capital, who sits on the investment committee and also serves as chairman of their board. We will then have the opportunity to open up to questions from the listeners. So to ask a question, simply type it in the Q&A section in your Zoom panel. You can ask them at any time during the presentation, and we'll get to it in the last 10-15 minutes of the presentation. We're going to try to keep this around 30 minutes. So if we don't have a chance to answer all the questions, we'll follow up afterwards. And before handing it off to Xingtai, I just want to give a quick overview of how Milltrust fits in. Our approach at Milltrust is to identify leading locally based investment managers in each of the key countries and regions across the emerging markets who are specialists in putting together high conviction portfolios of high quality companies. Each specialist team, which you can see here on the map, manages the regional portfolio within a sub-fund on the Milltrust Emerging Markets Platform. These sub-funds form the basis of our global EM strategy. Investors can either invest directly into the sub-funds, such as the Milltrust Xingtai China Fund, and build their own exposure to these countries and regions, or invest through the Milltrust Global Emerging Market Fund, which allocates across these sub-funds of the platform. So that's enough from me. I'm going to now hand it over to Michelle. Over to you, Michelle.
Thank you very much, Eric, and good morning to everyone. Nice to meet you all on Zoom, and I will give an overview of Xingtai Capital, our firm, an overview of our strategy, and also talk through a few of the stocks that we currently own to give you a flavor of what's in the portfolio, and then we'll open up to Q&A. So we're a long-only China fund, and the way we describe ourselves is we are a value-driven investor in Chinese growth. What we mean by that is our primary objective is to invest in the highest growth equities we can access, agnostic of sector. And whilst we want to capture high growth, and that is our core mission, we pay a lot of attention to the margin of safety. So we don't want to invest in growth regardless of valuation. In fact, we want to invest in growth with a very strict value overlay. And that's how we're quite differentiated in terms of our portfolio and our performance. So I'll go through a little bit about the firm first before I dive into the strategy. So we're currently around 500 million in firm-wide assets. We started the firm in 2014. And the data in this pack you'll see is from our main fund, which is a Cayman Master Feeder Fund. We also run a UCITS vehicle, and as Eric just mentioned, we're also the China fund on the Milltrust platform. So we have a over 5-year track record, and we're annualizing around 23% over 3 years and around 31% over 5 years on the Cayman fund. And that represents very strong outperformance over the index and over peer funds. And the portfolio is very unique. You know, it has very high growth, over 30% EPS growth currently, and currently it's trading at 16 times PE, historically at around 13 times PE. So I'm the founder and CEO. I'm from Hong Kong originally. My background is from the private equity and operating side. So I started life working for Goldman Sachs after being at HBS. And I then was hired to run a listed China consumer company, Tom Group, which is associated with the Hutchison Whampoa Group. That was when I got my operating experience working within the China consumer space. After that, I was part of a team that started a private equity fund, Luna Capital. And I was in private equity for 6 years before starting Xingtai Capital. The reason for starting Xingtai Capital is I thought that the way to invest successfully in public equities is to take more of a private equity approach. We started the firm in 2014. Soon after inception, I partnered up with Bing Chao Zhao, who is my equity partner and currently CIO of our firm. He is from Zhejiang province, China, originally, went to Dartmouth College for his master's. And his background is all on the public equity side, first at Goldman Sachs in research, and then with a number of long short funds, first Citadel and then SAC. So we come from very different backgrounds. He comes from more of a long short background. I come from a private equity background. And we both have very high conviction that the way to invest in China is to adopt a long only strategy and focus on investing only in growth and consumer driven equities, and take a very on the ground proprietary research approach to investing in these stocks. So our strategy is entirely bottoms up. The investment team is entirely based in Shanghai. Behind Bing Chao, we have 6 analysts based in Shanghai, and everything non-investment related is based out of Hong Kong. So operations, investor relations, all based out of Hong Kong. We're a team of 13 in total. So let's talk a little bit about the strategy. So we want to invest in high growth, and we want at the same time to stick to very attractive valuations. So we try and avoid some of the consensus names that most of the other long China funds invest in. So in our portfolio, you will not see commonly held names like Alibaba, Tencent, or other of the big staples names like Moutai. But you'll see names that you may not have come across before, because in general, we tend to invest in names that represent value dislocation. So names that are trading at very attractive PEs, usually sub 20 times, but offering very high EPS growth. So the average portfolio PE since inception historically has been around 13 times PE and offering around 30 times EPS growth. Now, how do we find stocks like this? It sounds too good to be true. Very cheap, yet high, trading at delivering very high growth. So what we do is we focus on picking stocks that are off the radar of the bigger investors. These stocks can be stocks that maybe are too small for the big investors investing. They're small cap or mid cap stocks, or they're very new secular growth stocks, secular growth sectors that big investors are not focused on, or they're going through a recovery track and investors are not focused on the fact that there's a turnaround in play. But whatever the reason, we have a track record of identifying stocks at the early on in their cycle when they're trading at valuations that are extremely attractive, at or below intrinsic value, and offering very high growth. So oftentimes when we invest in these stocks, there's limited or no sell-side research coverage when we first invest. So on this page, you'll see a list of stocks that we invested in the last 3 years. And in each case, we invested at sub 15 times PE. The stock, we knew from directly interfacing with management that the stock was going to deliver greater than 25% earning growth. And there was a value dislocation presented between the price and the earnings. So what we've seen in our track record is our ability to invest early in stocks that represent very high growth, and they've gone through a very strong re-rating after we invest. So we have stocks in our portfolio that have gone through re-rating up to 5x, 10x, 13x, and that has driven the alpha generation of the fund. Given that we're often investing in names that are off the radar of a lot of the bigger investors, our overlap with the index, MSCI China, is minimal. So we're not benchmarked off the index. So we're not constructing a portfolio to beat the index, but we use the index as a reference point for our performance. And you'll see from our performance profile that we only have about 3% overlap with MSCI China. So we think this is the way to invest, to be on the ground, talk to companies directly, to discover stocks that are maybe off the radar of large investors, trading at dislocation. And we often have seen in our portfolio stocks that have re-rated and presented strong market cap migration stories at the same time. So you'll see from our 1, 3, 5 year performance that we're delivering strong absolute performance. In fact, over our 6-year track record, we only have 1 year where we did not deliver absolute returns. That was 2016. And in some of the years where the market was very volatile, like in 2018, when the market was down 20%, we still managed to deliver strong absolute return of 5%, even though we're a long only fund. All the performance we generate is through stock picking. We don't hedge, we don't use leverage, we don't use cash as a hedge. The strategy has managed to outperform a lot, but at the same time, an interesting aspect of the strategy is that the strategy has presented strong down market protection. So in this graph, you'll see over the past 6 years, the track record, us versus MSCI China, and you'll see that we're able to deliver around 50% down market capture in months and years where the market has seen a lot of downdraft. And we see that a lot in China, right? So last year was a very strong year. 2020, the index was up 20%. We managed to beat the index. We're up around 40%. But we expect this year, 2021, to present more challenges, and we expect that a lot of the consensus names will derate. But we feel confident that our portfolio is well positioned because the valuations we're in are strong, and a lot of the upside that we experienced last year was due to earnings growth and not to multiple expansion. Whereas the index, the growth last year was primarily coming from multiple expansion. So let's talk a little bit about stocks we like. So we like stocks that present high growth. So we're focused on trying to find strong secular growth or strong recovery growth. And we like businesses that have strong brand equity, strong competitive positioning. We prefer stocks that are in net cash position. We don't like companies with a lot of leverage. And most importantly, we require strong management access. So for the stocks in our portfolio, we talk to management every month. We feel that the competitive dynamics within these companies in China changes quite rapidly, and we feel we need to have our finger on the pulse. So we really rely on these monthly check-ins. So the portfolio you'll see on this page on the right-hand side, today we have 39 stocks. P of the portfolio is around 16 times. If we strip out cash, the PE is around 14 times. So how do we pick these stocks? What is our repeatable process? We use this framework that you see on this page, which we call the operational cycle theory, to focus our research efforts. So although we're mainly investing in stocks that are where there's a strong domestic demand theme, so we in general don't invest in financial names or commodity names. We're mostly in consumer-driven equities, but not exclusively. And obviously, a lot of consumer names or growth stocks are not supposed to see cycles. But in China, given the rapid change in the market and given how young the economy is, we are seeing cycles in the companies that we're researching. So what we try to do is we try and invest at the right time. And what we want to do is we want to invest when the stock is either in strong secular growth, as early stage 1 on this graph, or strong recovery growth, so late stage 4. So what we try to do is always invest in companies that demonstrate characteristics of these two cycles: strong secular growth or late stage strong recovery growth. So I'm going to talk through 2 case studies quickly before opening up to questions to give you a flavor. So these 2 stocks are both currently in our portfolio. We've held these stocks for 3 years. Our holding period is usually 3 years. That's what we target. And we build all our financial models on 3-year basis. So Yardi is an e-bike, e-scooter brand. It's a leading market share brand in China within its sector. There are 2 other names in the sector, one listed on the A shares and one listed on the US ADRs. This is the leader in terms of market share. It has about 25% market share currently. We invested in this stock in 2018. This stock was off the radar of a lot of the big investors. We invested when the stock was trading at 8 times PE. It was a small cap stock. There was not a lot of attention, but by directly interfacing with management, we understood how strong the growth was going to be. And in our models, we were showing the stock was going to generate around 30% EPS growth, and it was trading at 8 times. So it represented a very strong risk reward profile and a strong dislocation thesis. We invested in 2018, and we've held this stock for the past 3 years. The stock has delivered an 8x return for us because after a 2-year holding period, when the sales revenue reached scale, which was around 500 million renminbi, large investors started paying attention. And in the first half of 2020, the stock delivered 100% net income growth, despite a very challenging operating environment with COVID. So this is a very clear example of what we do well. So we spotted this stock early when no one was paying attention. We invested at a very dislocated level, 8 times PE. The stock has gone through a massive re-rating, has gone from a small cap stock to a large cap stock. And it's not a consensus stock, but is now well known in the market. We believe that the profitability will be much increased from here on out. So currently their margins are in the high teens. They are trying to get from 25% market share to 40% market share over the next 18 months. And their strategy has been to be very generous with the distribution channel. So with every bike they sell, they retain 1/3 of the profits and they give 2/3 to the distribution channels. And this way they're able to really build their footprints and grab market share. Once they reach around 40% market share, their intention is to then hike up margins and to take more of the profit away from distribution channels. So we expect to see the profitability of this company and the margins to increase substantially within the next 18 months to 2 years. So although the stock currently is trading at 35 times PE versus 8 times when we first invested, we feel that it still makes a lot of sense. The risk reward profile is attractive and we still hold this stock. The next stock, Bozidang, is China's largest down jacket manufacturer. It's a very big brand in China. The company was established about 30 years ago. And the company went through a lot of challenges and lost about 80% of the market value in the year of 2012, and then went through restructuring and recovery. We invested in 2016 when we determined that the stock was in late stage recovery growth. They had gone through 4 quarters of recovery in terms of same store sales growth, as well as net income. So we invested in mid 2016 and we were early. You know, for 2 years, the stock didn't do anything and was flatline. We held the stock for 2 years and we were patient. We often have to be patient because we're often in stocks that are very cheap and off the radar of the big investors. So sometimes we have to be patient before the stock re-rates. But when the stock does re-rate, it can be quite vicious. So in the case of Bozidang, the re-rating occurred in the second half of 2018 when the revenue had reached a bigger scale. And the stock has also delivered very strong returns for us. We still hold the stock. So when we first invested, the stock was a late stage recovery play. Currently, we believe the stock is in stage 1. It's a strong secular growth stock. We think that they can increase their profitability substantially from here on out because they've spent a lot of efforts and investments building their brand. And the brand now is quite a strong aspirational brand within the apparel sector in China. So I'll pause there for questions. Thank you.
Thank you, Michelle. Yeah, we've got a number of questions coming in here. One, I'll start with this one. There's a couple questions on internet stocks, e-commerce stocks, and how do you see Chinese internet e-commerce stocks doing in 2021? Any particular sectors in the sort of new economy space? And there's a couple names that we had attendees send through. One is on the some online brokerage firms such as Futu and UpFintech. And also Bilibili, which is the online entertainment platform. So just a comment on that sector and on any of those stocks, if you have anything to say.
Sure. So we have minimal exposure within the internet economic sector. So it's not because we don't like these companies. We think these companies are great companies, but oftentimes the valuations don't fit our framework. So, we're investing mostly at sub 20 times when we first invest, and a lot of the internet stocks and TMT stocks are simply not trading at that types of levels. We think that the larger consensus names will face a lot of pressure. They have already derated substantially since last year, and we expect that derating to continue for 2 main reasons. On the one hand, it's for valuation reasons. The stocks ran up too much, and there was a bubble within some of the large cap TMT stocks, and we think that bubble is going to burst, and it has burst, and it's going to continue to derate from here. Second reason is political. The Chinese government has indicated that Tencent, Alibaba will face pressure to be more accountable in terms of anti-monopolistic type of market practice, and we do think the government is quite intent on breaking up some of their dominant market share in certain sectors. So we think both because of valuation and political reasons, the bigger consensus names will derate. There's still a lot of opportunities within the niche names. So for example, we like JD. We still hold a small position in JD in our portfolio. We like stocks like Bilibili, although we don't own them because of valuation reasons. We think you have to be selective when you look at TMT names from here on out, and you have to look at names where they're defensible business models and where stocks where they're not going to be subject to government regulation and government scrutiny.
Okay. Another question here. Do you only invest in profitable companies, or do you have holdings focused on market share growth and future profitability?
We like to generally take a forward-looking view. So, if you look at a stock like Yardi or Bozidang, we look at forward earnings, we look at potential of market cap migration. We're quite forward-looking in terms of how we evaluate the stock's risk-reward profile. We generally do not invest in stocks that are pre-profits. So, 98% of our portfolio is in companies where there's a track record of earnings. In fact, we're very focused on looking for strong core cash earnings. On an exceptional basis, we may look at a stock that is pre-profits if it presents very strong market share dominance potential. But those are the minority, and very infrequently will we invest in companies that are pre-profits.
Okay, I'll keep it going here because they're coming in thick and fast here. What about small caps? Perhaps what is the average market cap of your strategy, and how important are small caps in the portfolio? And do you see any issues with that as AUM grows?
So our market cap exposure breakdown is roughly as follows. So we have about 50+% of the portfolios in mid-cap stocks, then about 20+% in small caps, and 20+% in large caps. When we look at a stock, we're totally bottoms up. So we're not only looking at certain market caps. We look at the stock based on what's attractive in terms of the risk reward profile. But in general, we have invested a lot in smaller mid caps because we've seen more opportunities for value dislocation in smaller companies. But often when we're looking at a stock that is small cap, we will be forward looking. In other words, we will want to assess whether or not we see a market cap migration in the stock. So in fact, our sweet spot has been stocks that trade just below 1 billion US. So for us, the definition of mid cap is 1 to 5 billion US. And our sweet spot has been sub 1 billion US in market cap, because what we've found is that stocks that are just below 1 billion and where we see a path to re-rating and market cap migration, once they hit 1 billion, the re-rating is very rapid and there's a lot more market attention. So a lot of examples in our portfolio, for example, with Bozidang, with Yardi and other stocks, were sub 1 billion when we first invested, and then quickly migrated to mid cap. And both in the Yardi's case, it's now a large cap stock. In Bozidang's case, it's still a mid cap stock.
Okay. And what is your approach in allocating between A and H shares? Is there a better time to invest into each?
So historically, we've had more H Hong Kong equities exposure. And this is for two main reasons. One reason is because of our value overlay. In general, we like to pick cheaper stocks, and the valuation discrepancy between H and A has been quite substantial, especially in mid-small cap growth stocks. So the valuation discrepancy can be anywhere from 20% to 100%, where the A shares are, trading at a 20 to 100% premium to the H shares. So because of our value focus, we've often picked the cheaper stocks, so the H shares. And also we're more comfortable with a market that is more fundamentally driven. And in general, over the past 5 years, certainly in the first 4 years of our track record, the Hong Kong market was more of a fundamental market, more of an institutional market. That is changing rapidly. So what we've found over the past 2 years is that the A shares have really gone through a path of institutionalization. And we see that the market is much more fundamentally driven today than it was 3 years ago. And in fact, within our pipeline, we have a lot more A shares. And we're seeing a lot more opportunities on the A shares that fit our growth with value framework. And currently our Asia exposure is about 10%, but we expect that exposure to increase over time should we continue to find the opportunities that we're seeing today.
Okay. And can you comment on the recent Chinese 14th five-year plan and what implications they might have for your portfolio going forward?
Sure. So we're bottoms up. We obviously follow all the macro news and we're focused on the market movements and all that. But our decision making tends to be quite focused on just a bottoms up decision making. So we're stock pickers. But obviously, we look at the 5-year plans and the government announcements. What we expect to happen in China going forward this year is a marginal tightening. So we think there's ample liquidity in the market in 2020. Easing like in the rest of the world. We do think that the government will readdress this policy, and monetary policy will tend to be on the tightening side going forward. The government has already made announcements that they consider what's going on in the equity market, the portion of the equity market and the real estate market to be in bubble territory. So we expect them to address some of this through more tightened policies. Also, in 2020, China did very well with exports. The rest of the world was really impacted by COVID. China was early in that recovery from COVID, and China managed to really grow a lot, also exporting a lot to the rest of the world, which drove up the renminbi. We expect also the renminbi to depreciate from here. We're trading at a 3-year high currently. And we expect exports to gradually trend down given that the rest of the world is now vaccinating and recovering. And with that export decline, we expect the renminbi to also further correct downwards from here.
And are you seeing a move from growth to value in the China-Hong Kong market? And how long do you expect the reflation trade to last?
Yes, we have seen that in the past 6 weeks. So, 2020 was a very strong year for Chinese equities in general, and in particular for the Hong Kong market over the last 6 months. And over the last 6 weeks, with this correction that we've seen in the consensus TMT names and staples names, we've seen a sector rotation back into value names. We think that may continue going forward because there's still needs to be further correction within some of these TMT staples names because they've just gone up so much over the past 14 months. So we expect that trend to continue. In fact, interestingly, at the beginning of the year in January, we were quite frustrated because the index was so strong, because the index is largely driven by some of the TMT names, and our performance trailed. But as of this morning, we're seeing that that's already reversed. We're now beating the index, the MSCI China, on a year-to-date basis because a lot of these high flyers are now coming back to earth, and the index is correcting as a result as well.
Yeah, no, we've certainly seen that. There are coming a couple more questions here, and then we'll have to wrap it up. If you expect, this one just came in here, if you expect a slowdown in exports and more tightening, what would be your approach to being more defensively positioned?
That would not impact us. So if exports are in decline and if there's more tightening, that would definitely not impact us because we're mainly invested in stocks where the growth is riding off of strong domestic demand, strong domestic consumption demand. So any change on the export side or the currency side or tightening will not substantially affect our strategy.
Okay. And then there is a question about your thoughts on BYD. I mean, you make a good case on Yadea, and then also on the, China is a leader in the low carbon technology. And do you have a view on this and on this theme? And do you have any exposure to that sector?
So e-scooters and e-bikes is a totally different thing from electric vehicles. So the electric vehicle sector is very hyped up, trading at valuations that don't make sense to us. And interestingly, even a lot of retail investors mistake Yadi as being within the electric vehicle sector, which they're not. Yadi's currently trading at 35 times PE, delivering around 40% EPS growth. We don't like BYD in the electric vehicle sector. That doesn't fit our investment framework. We like Yadi because it's got a very strong competitive positioning. It has dominant market share in its sector. It's the largest, most well-known brand in its sector, and it has built a very large footprint of strong distribution channel relationships, which it can now monetize because it can quickly go from owning a quarter of the market to owning close to half of the market over the next 2 years. And as a result of that, they can start hiking up the price and also taking a greater share away from distribution channels, thereby increasing their margin. So that's a kind of stock profile that we like. The electric vehicle market, a lot of these companies are pre-profits. They're trading at very elevated levels. They're just not the kind of stocks that we focus on or we invest in.
Okay.
Environmental carbon footprint. Sorry, that's not something we've invested in so far either. So we like really simple. We like really simple stories. We like big consumer brands, consumer services companies, where we think the growth will be very strong over the next 20 years. We're looking at only holding stock for 3 years, but most of the time, we want to hold for longer term. Some of the stocks on portfolio, like Bozidang, we've held for over 4 years now. So we think this theme in China of growth in domestic demand, growth in consumer demand, is a multi-decade type of theme. And what we're trying to do is invest in stocks that have exposure to this theme, and stocks that represent very strong risk-reward profile, that are very high growth, but are attractively valued. And that's what we do day to day. We pick stocks that fit our framework. And we're one strategy firm. We've never deviated from this strategy. We've been doing this from 2014 onwards. And even in very volatile market conditions, like 2018, when the market was down 20%, or like last year when we were hit by COVID, we just stick to what we do well, which is picking stocks that fit our framework. We try to not get too influenced by what everyone else is doing or what everyone else is talking about. And we also try and not invest in any of the momentum stocks that everyone is rushing into. And hopefully that will do us well in a year like 2021. We think 2021 will be more challenging for your average investor within Chinese equities. The index may face some pressure this year. Some of the consensus names will derate this year. But we think in a year like this, that's when we can differentiate in terms of our performance profile.
Yeah, and I agree. And Michelle, last question. This is really the last question now. One of the themes you've been playing, and you've advertised it in your newsletters and commentary, is the property management services theme. And this is a theme that I think you identified a couple of years ago, and in a way you've been patient to see it play out. Earnings are coming through this month. Maybe you can just discuss that theme, how you seeing it today, and do you see more legs to that opportunity?
Sure. So property management services, so these are asset-light companies. They provide services for residential and commercial properties, so car parking services, gardening services, security, and they also provide value-added services. So this is a China twist to this sector. In the rest of the world, you only provide your traditional services. In China, these companies are doing things like leasing properties. They're providing childcare. They're providing grocery shopping assistance to their residents. Why this is interesting is because it's mainly a structural opportunity. So these companies were mainly spin-offs from larger property owners. And all these property owners were offshore listed structures. So they could not list on the domestic A shares because they're all overseas owned. So the reason why this is a very interesting opportunity is because we've seen 40 companies list within the sector on the Hong Kong market over the last 4 years. And we do believe that we're now at saturation point. So anyone who's going to have an IPO within the sector has already done so, or the pace of the IPOs within the sector will slow down from here. And what we're seeing is that these companies now are listed. They have a lot of cash on their balance sheet, and they have access to the capital markets, and they can now further grow their market share. So they can acquire more GFA within the regions where they operate, and they can also take out some of the smaller guys. So the big listed guys can start acquiring the unlisted guys, or the bigger listed guys can start acquiring the smaller cap listed players. So it's a consolidation play as well as a high growth theme, because there's an upgraded lifestyle in China. You know, people are willing to pay more for their property management services. They're willing for the property management services companies to take on other properties where there was previously no property management services on offer. So it's there's so many themes encapsulated within the sector. There's the growth theme in terms of upgraded lifestyle. There is the theme of consolidation within a sector that is totally brand new to the market. You know, this was an unlisted sector 4 years ago. And there's also a theme of structural opportunity. You know, these companies can only list in Hong Kong. They cannot list in the A share. So their access to the capital markets is defined by that structural position. So we're very bullish about the sector. We hold 6 names in the sector.
Yeah, no, that's it's very interesting. So I think, as I said, that was the last question. We've run out of time, but Michelle, thank you for your very interesting, insightful presentation. We have some more questions, which we will follow up afterwards by email. My team will also circulate a recap of the call for those that couldn't attend and for those that want to review the notes. As a reminder, we have more webinars coming up in the next couple weeks, focused on our other Asia regions from the platform, Southeast Asia, Korea, and India. So please get in touch if you want to join for those. But signing off here, Michelle, thank you. And hopefully you found that interesting. And we look forward to speaking to everyone soon. So thank you very much.
Thank you very much.